I'm the broker of Just Global and host of GREI, Global Real Estate Investor Club. And we've been hosting regular events to enhance the understanding of the Bay Area market, and the legal and tax experts being invited to share their thoughts and insights about the investment and property owning arena. So today, we are very, very happy to invite Mr. Michael Lee, who's an attorney that will be sharing with you about his observation on why living trust is important, and also more advanced planning on this side. Mr. Michael Lee founded the Rue Attorneys after service as an attorney with the IRS, U.S. Attorney Office, and the U.S. District Court. His founding objective was to bring his experience in federal to a broader array of individuals, business, and international clients. The primary focus of Michael to practice the structural international business transaction and also wealth management for families to promote tax efficiency by the U.S. foreign treaties, and also the sophisticated multi-model estate planning. May we now invite Michael. Good morning, Michael.
Oh, good morning, Monica. It's a pleasure to be here.
Thank you.
Great. Well, thank you so much. Very excited today. We are, of course, approaching tax season, so we have a lot, I think, on our minds. But this is going to be, I think, a useful opportunity and exercise, because since we have all the records out, we have all the binders out, we're preparing for taxes, we should also think think globally, think about what we're doing, because if we're going through the endeavor, let's try to handle everything all at once. So I have a few slides here. I will just add, just to give a little intro here. So 2024 tax season, it's about estate planning and asset protection that we'll be talking about right here. So since we are beginning to prepare our taxes April 15th, for this year, what should we know? We'll talk about that. So just a little bit about us. Monica gave a great introduction. So RUI Attorneys, we have two founding partners, so myself and then my partner, Xiaowei Li. So both every year, longer and longer terms of practice. Started out practice with the Internal Revenue Service, then I was with the U.S. Attorney's Office, generally both in tax, and when I was with the U.S. Attorney's Office in bankruptcy practice, which is critical for asset protection. I worked for the district court for a number of years, and then have been in private practice ever since. Partner Xiaowei Li, graduate of Wuhan University, China, the law program there. So sophistication in understanding of the Chinese legal system, practices in estate planning with me as well. And of course, we have full English and Chinese, and due to my excellent paralegal, also Cantonese services, whatever one may like. So just moving right along here, thinking about our goal and thinking about what we're trying to do with estate planning. Since now we are in the 2024 tax season, we're going through all of our, we're going through all the W-2s and the 1099s and 1099 INTs and all this this work, and we have all the bank statements out. Now is a great time to look at your estate plan and say, we did an estate plan a few years ago. What do we have? What's in there? So critically, now's the time to do it. Pull out that binder, pull out that folder, make sure you can find it. If you can't find it and don't know where it is, there's a clue what you need to do. Once you get it open and you're taking a look at it, start taking a look at the plan and things to look for. And I'm going to start to give you some clues. What you want the plan to do, of course, is to accomplish basically the things in these four boxes. Manage assets during times of incapacity, If one passes away, next box, allocate, transfer, hold assets for beneficiaries. For married couples, manage assets for the period of time after one spouse passes away, and then accomplish all of the above with low cost tax efficiency. So the first thing that one has to take a look at when you pull out the binder and do your annual checkup as you do your taxes, checking your estate plan, make sure you can find the estate plan. Make sure all the instruments are in the estate planning folder, the estate plan binder. Do you have the trust? Do you have the wills? Do you have the power of attorneys? Do you have the healthcare directives? Those 4 items, you should find 4 of those items. Trust can be joint husband and wife, but each person, husband, wife, each needs a will, each needs a power of attorney, each needs a healthcare directive. Make sure you have those together. Why? I have a case right now that is a very disappointing case because what happened? They are missing the power of attorney. And here's the story of what happened. Had husband and wife, they're doing well, living in the Bay Area. Husband, unfortunately, has a stroke, a fairly debilitating stroke. He's in his 70s about the time that he has the stroke. His wife is about 10 years younger than him. No problem. She takes care of him as a good married couple. They, time advances. It's about 10 years later. She's 70, he's 80. He is still debilitated with a stroke. Unfortunately, she passes away. So it's just now husband who had the stroke who's debilitated. They had, as written in the 1990s, a great estate plan. It had the trust, had the wills, had the healthcare directive. The power of attorney has been lost. We go and look for the binder. Where's the power of attorney? What happened? This piece is missing. We can't find it. I think, unfortunately, somebody probably took it out and said, oh, you know what, this is important. I'm going to keep this in another folder. Now we don't know where it is. What's the problem? Husband and wife, they had a very, very large bank account that they used, nearly $1 million in the bank brokerage account that they were using to live, and then all of the income was coming into that. It's not in the trust. There's another problem that we'll talk about, funding the trust, making sure things are in the trust. But what is traditionally used as the bridge to pull that into the trust, the power of attorney, to bring that from outside into the trust, is missing. So what ends up happening, we have to do a conservatorship case. What was the problem? The binder existed, but the pieces were not all there. Like doing a jigsaw puzzle, you're almost to the end, and then you're missing the piece, and you can't complete the puzzle. So first thing, take a look, make sure you have all of your estate planning documents. In addition, this was a defect in this plan as well. Check to make sure every major asset is funded into the estate plan or otherwise dealt with. Again, tax time is a great time to do this because you already are going through the accounts, you already are collecting the bank statements, you're already doing a rough inventory of the things that you have. Check and say, the house or that rental house, that Tahoe rental house, we put that in the trust, right? And we did a refi in 2014, that after the refi, it's in the trust, right? We have the deed, right? You better check, because if we find out that the property's not in the trust, then you might have some problem where you're going to have to ask a court to order it in or do some procedure. So check real properties, make sure they're in the trust. Since you're looking at the bank statements, take a look at bank accounts. If you have brokerage accounts, Schwab, TD Ameritrade, Morgan Stanley, all of those, it's a brokerage account. It's not retirement. It's brokerage account. Is that in the trust? Did we change the title? Did I give my financial advisor the trust certificate to put that into the trust? Uh-oh, I look at the statement, it says Mike Lee alone. Clearly I didn't. Clearly it's titled in my name. How much money is in there? More than $188,000. I kind of have a problem. If there's a power of attorney, I can get it into the trust, but maybe I just want to title that into my trust. It's not going to cause any negative tax effects or anything like that. let's try to get this in there. So again, since we've already got the statements out, it's a great place to take a look and make sure things are in there. So make sure the trust is funded, the stuff is inside the box. The other thing that we want to take a look at, and we'll do a rough run through for, let's actually open up that trust. What do I mean open up the trust? Let's take a look and read it a little bit and make sure it's achieving our goals, achieving our objective. So manage assets during times of incapacity. Trustees are the trustees that you've chosen. If I'm not here, then my wife, if she is not here, who's next? Are those the right people? Are they still the right people? People, trusts like clothing, we sometimes grow out of them. So I may have had a great design when my children were very small, but now that they've grown up, my design's not so good. So check the trustees. The second part also, of course, is the allocate and transfer assets to beneficiaries. Check the beneficiaries. Are all the beneficiaries the persons that you want? Is anybody not included that should be? Anybody that's included that shouldn't be? Also, for the beneficiaries, is there any reason why what they are receiving should be done in a different way? What do I mean? Modern, recent estate planning is actually changing quite a bit from the old way that used to be done, where beneficiaries would be given what was called an outright gift, where I'd say half to my son and half to my daughter. I just say half, and they get it 100%, no strings attached. That has historically caused a lot of problems when people get the money outright. It doesn't necessarily ensure prudence, and it can sometimes place the money at risk of creditors or divorcing spouses or other risks there. So the more common way that is now becoming quite popular is in situations that instead of giving my children an outright distribution, I give them a right to withdraw. Instead of giving them cash, I give them a debit card. I control the bank account, or essentially the trust controls the bank account, but they have a debit card and they can withdraw out under certain rules. That is safer for beneficiaries, and of course is generally thought of when we have young beneficiaries, 18, 20s or so, but it can be appropriate for all levels. It also is something that can be appropriate, or a design of this. Do I have a beneficiary in my life that is a special needs or supplemental needs person? I can't give them an outright distribution. It might disqualify them from a government benefit program, or they personally may not be able to manage it. So what would be better for them? To grant their share in a supplemental or special needs trust. So thinking on the other side, we thought about who's the person to manage it, make sure our trustees are updated. On the second portion, think about the beneficiaries. What kind of people are they? Are they good at managing finances? Are they not good at this? How old are they? How young are they? How should the distribution be done in the most effective and safest way possible? So those are the top two. The number 3 item, this is for married couples. This is a big thing. So this is something in your notes for our program today. I put a star by this if you're a married couple. How the estate tax works for married people. And if you've been following this area, which few people do, and have followed the history of estate tax, unfortunately, the estate tax in the United States tends to be a very political tax, and the code, the law, changes. And for the operation of the estate tax exemption for married persons, there was a major conceptual change in the year 2010 that then became final in the year 2013. So a while ago. It is about 10 to 11 years in the past. What's the takeaway? If you have a trust that you have not amended that is older than 2013, and definitely if it's older than 2010, if when you take a look at the trust you say, wait, this is dated 2007, and have you amended, restated it since 2007? No, it's exactly the same form as it was in 2007. You need to visit an attorney to take a look at this, because it may have provisions that are very suboptimal in the way the law works now. What's the change? The change is this: under the old pre-2013, pre-2010 law, the estate tax exemption per person, per husband, per wife was non-transferable. It was use it or lose it. And if you didn't use it, you lost it. So what do you mean use it? You had to claim the exclusion in the 9 months that the person passed away and lock those assets into essentially an irrevocable trust. So most quality trusts before 2013 and before 2010, they have what's called an AB trust, the locking system, and they have a formula that basically says whatever the individual exclusion is, fill up that A trust, lock it, and then the remainder will go to the B trust that is revocable. The problem is, what's the problem with this is, number one, in the law that we have now, we don't necessarily have to do this, but having an irrevocable trust that contains half of a husband and wife's assets is very difficult to administer for the surviving spouse. The surviving spouse now has an irrevocable trust with half of essentially what she thought was her stuff, her and her husband's stuff, and she now has to file tax returns for this. So every 1099 INT, you're going to have to divide it in two. You have to then have half his wife, half is the A trust. Then you have to take that income and run that income through the 1041, and then you have to issue a K1 statement over to the wife. It's really, really troublesome. And the good news is, for modern planning, and I say modern planning, for current planning since 2013, not all families need to do this. Only families that are of very, very high net worth, or for a few other reasons, need to do that AB locking, firm locking system. So because of that, you may have a trust that you say, oh, it's a good trust. I did the things you said, Mike. I checked the trustees. I like it. I checked the beneficiaries. I like it. Oh, but is the trust older than 2010 or 2013 thereabouts? Oh, it is. Well, you may like the trustees and you may like the beneficiaries. That's designed well, but the division and allocation of the way the estate tax operates, that may not work well. So older trusts, take a look because of the way they operated with regard to marital assets and how they allocate the marital exclusion. So old trusts, take a look at old trusts. The next thing to take a look at is we want to accomplish all of the above with low cost and tax efficiency. So we talked about the estate tax a little bit for the allocation of husband and wife. And that tends to be a problem for older trusts older than 2010. But there's another curveball, the curveball of Proposition 19 that came out around 2021 thereabouts with regard to the family residence. And now, for the family primary residence, we, because of Prop 19, do not have the old Prop 58 rules. The old Prop 58 rules were if it's my husband and wife, it was our family home, and then it goes to the children, as long as it goes from parents to children, they keep my property tax basis. That's it. They keep my property tax basis. It doesn't matter how much value the home has increased, and it doesn't require them to live there. It was just as long as it was my primary residence, they got it. That changed with Proposition 19. And Proposition 19, there was the good part for older Californians. You can transfer your property and take the property tax with you if you buy a property of equal or lesser value. That part was good. That fixed the law. But then it caused this sort of curveball that was intentional, that was slid in there, that basically causes reassessments of property, many properties upon the death of the owners. And the new rule is this, is that husband and wife, we have the family home. Family home, we can transfer at our death, family home via our trust. to our children, but they can only keep my property tax basis if two conditions are met. One of my children has to live there. So we can't do the old system that we used to have where, daughter's in Seattle, my son is in Los Angeles, they'll just keep the family home as a rental and they'll make a lot of money because they'll keep mom and dad's property tax basis. That doesn't work anymore. That explicitly violates Prop 19. One of those children has to come back and live in that home and claim that as their primary residence. It's going to be very hard because if my daughter's in Seattle, she says, Dad, I don't have income tax. I don't want to claim that. If I claim that as my primary residence, but I really live in Seattle, I'm going to actually owe California income tax that I don't owe. So I don't want to say that I live there. And my son, if he already bought a house, he said, I have a problem. I don't necessarily want to claim that house as my primary residence either. So what we have to think about with revocable living trusts and the transfer of a family residence now is we have to think about, do we need to do something where actually one child does want the house and maybe we steer that house to that child and then we allocate assets more to the other one. So we say, okay, you'll take the house because you'll live there and you can keep the property tax basis, and then you'll take the financial assets because it's liquid and we can balance it out. We have to start thinking through the primary residence with more sophistication because there's a residency requirement. We also have to think through is that there's now a dollar limit. So if the difference between my adjusted base value, basically the value that I'm being assessed on for property tax, and the fair market value on the date that I pass away, if that is more than $1 million, the amount over the million is going to get added back to the basis and increase the property tax for my child. So let's say my adjusted base value is 500,000, but by the time that I pass away, the home is worth 2 million. We have 500,000 plus $1 million. So there's 1.5 million. There's 500,000 over. That 500,000 drops back down. My child will now have the assessment on 1 million, not 500,000. It's better than the 2 million. So it's half what the fair market value is, but it's not what I had. It's in fact double what I had. So that is a change for Proposition 19. Important to think about what Prop 19 is going to do, because a lot of the thoughts of we said, well, we'll just give everything half and half to the kids and they'll have that family house and all of that. Well, think about that family house. The property taxes may be much more expensive. So that may be helpful for the beneficiaries. It may not be helpful to the beneficiaries. Also, remember under Prop 19, if I have 3-4 rental properties, when my wife and I pass away, all of them will be reassessed for property tax purposes. All of them will be reassessed. So with that, those are all going to go to fair market value for property taxes. And just like I mentioned, do some calculation. What does that mean for cash flow? What does that mean for the profitability of those properties? When I got them at a great price and it was very good. But then if that resets to fair market value in the future, how does that impact the profitability of my lease? Commercial property, this is the other thing. If some of the properties are commercial, I should be thinking, maybe I should start thinking about having a triple net lease and getting the tenants used to that I pass the property taxes through to them. Because if it increases, if I don't have a triple net lease, I may be stuck with that problem. Maybe I should start acclimating the tenants that that's going to be on their side. So things to think about with that. The other thing to think about is the global, our grand property or our grand estate taxing system is we are, all good things must come to an end. And the party will unfortunately soon end on our high exemptions. So our high exemptions, what does this mean? Is presently, actually this year, the estate tax exclusion for an individual is about $14 million. So a married couple is about $28 million. that if they had $28 million or less, they would not pay estate taxes for that property there under the $28 million. This ends December 31st, 2025, when it crosses over to the year 2026. So that New Year's Eve, once it crosses into the year 2026, that ends. And it drops back down to the base is 5 million, but adjusted for inflation, it will probably be maybe 7 million, about half of what we have now. And that is going to then cause, let's say, that same couple that they said, well, we could get 28 million through tax-free. We'd say, oh, you can now get 14 million. The other 14 is taxed, and it's taxed at a 40% rate. Massive, massive change. So now we're in the year 2024. We have 2 more years left, less than 2, because we're, March. So we have less than 2 years left. We need to start thinking about if we are a higher net worth individual or higher net worth family, what are we doing to try to move these assets and start to do some estate tax planning? Because this adjustment down in the estate taxes, it's called a sunset. It's built into the law. So a lot of people say, well, Mike, how confident are you, that the estate tax exemptions are going to go down? How confident, are you on that? Congress always is kind of a mess. I saw they were doing some crazy thing this morning. How likely is it that they're going to do this? I say, this is a rare thing for a lawyer and a tax attorney. 100%. I can guarantee it's going to go down. Say, how can you be so confident? Because that's the law now. When they passed the law in 2017 with the Tax Cuts and Jobs Act, they wrote, this shall be effective until midnight, 2025, December 31st. At that time, it just drops down. It's already the law. That's already the Congress passed law. So that is it's called a sunset. They do this in the tax law fairly frequently. It's automatic. So actually the question is reversed, is me asking you, is how confident do you think Congress is going to extend this to pass essentially a tax cut for very, very wealthy people in an election year? Not super confident. For us in Silicon Valley, this estate tax seems like a significant tax. It is unfair and unjust. I will say throughout the rest of the country, people are like, soak those people in California, tax them. So I think it's not so likely that this will be changed in this year or the next year. So what we have to do, we have to prepare for it on our side and start preparing for arrangements in your estate, because the tax exemption is going to go down. What are ways that we could use to ameliorate the taxes? So one of my favorite things, and we talked about this, I think it was last year or so, with this very same group, is my favorite of the irrevocable trusts, because generally this estate planning involves, of course, revocable trusts. That's your core foundation, and then it will often grow to include irrevocable trusts. And my favorite irrevocable trust is the Irrevocable Life Insurance Trust. And why do I like the Irrevocable Life Insurance Trust? Because it is simple. It is easy to use, and it is not terribly troublesome, and it doesn't get into trouble easily. I often like to use metaphors and things like this. This is in terms of like getting a pet. Getting an irrevocable life insurance trust is like getting a fish. And getting a fish and putting the fish in the tank, you kind of don't have to worry about the fish all the time. There are other trusts that are like getting a large dog, a husky, and saying, the husky, you can't take your eyes off of it for 30 seconds, otherwise it will destroy something. You constantly have to watch it. The Irrevocable Life Insurance Trust, the ILIT, is like a fish. Very calm, very predictable, very passive. How does it work? And why do we do this? Why do we start thinking irrevocable life insurance trusts in play for larger estates? We'll see in a moment, though, not just larger estates, because they have excellent asset protection ability as well. So what is the Irrevocable Life Insurance Trust? It is a smarter way to hold whole life, long-term life insurance. So if I'm buying a whole life, universal life style policy, there's one way I can buy it. I could just go to my insurance broker and say, I'd like one of these policies. I'll say, sure. And I get the insurance, and it's on my life. The objective is generally to protect my family, children, wife, other family members, in case I should pass away. And I'm choosing this permanent life insurance policy instead of term, this permanent life insurance policy, because I want the investment aspect to it. I want it to accumulate value. I don't want a term policy that just eventually the term will expire and it will be too expensive to insure. I want to put the money in. I want it to grow and have residual value. So what is the estate taxing problem with this is that if I own it in my own name, Mike Lee, that value, the face value, the death benefit is includable in the estate tax calculation. So if I have, let's say I'm a single person, I have a $2 million house, and then I have, a 2 million in, brokerage, and then I have, 3 million, in, my retirement. So I have 4, 5, 6, 7. I have 7. I filled up my estate tax bracket, my estate tax pool. If I go and buy a $2 million life insurance policy, that is over my exemption because I've already used up 7. So what's the problem with this? I go buy this life insurance policy and say, okay, great. I like the life insurance policy. It's a sure thing, in case the market is down or, real estate is down and, there's some problem there. That all sounds good. What's the problem? I didn't buy a $2 million policy. I bought a policy that's probably about, let's say, 400,000. So 1.6 minus 2, maybe about a $1.4 million policy, face value policy. You say, Mike, how do you get to the 1.4? The $2 million will be subject to a 40% tax. And the 40% tax is the estate tax, because that is entirely unprotected after the year 2025, because I already filled up 7, 2 million's on the top. The top million of that which would be actually the 9th million, that's at a 40% rate. The lower part is at a graduated rate for the first million. So that's why I split it. I said 200,000. So actually, I would only be passing 1.4 million instead of the 2 million that I expected. And then when I compare, I say, wait, so actually the death benefit that they'd actually benefit from is only 1.4 million. Wait a minute, mathematically, this isn't a good investment at all. Then it doesn't really work well at all. How do I achieve this? Life insurance trust. Use the life insurance trust. You're not the owner. You're not the purchaser. You create an irrevocable life insurance trust. You have the neutral trustee. You design with your insurance professional, your lawyer, and together you design the policy premiums. And what I do, my $7 million, I pay the premium each year. I train this down. I transfer it into the trust. Ideally, I'm doing it in the amounts of the annual exclusion, but I can do it higher in some situations. And I fund the life insurance trust. At that point in the future that I pass away, my amount here is, let's say, $7 million. It's under the amount, no tax. This amount here, that's actually the $2 million, I don't own the $2 million. I clearly took the position and disclosed everything as is completely compliant with the law, that is an irrevocable trust. It holds the life insurance, and I'm funding it with annual gifts, which are disclosed and are completely fine. That is outside my estate. So in this example, doing the life insurance trust, I can get the full 9 million to the people that I want, and I don't have to pay any of the estate tax. Critically also, for the life insurance trust, it is low maintenance. All I have to do annually is to send the policy premium to the trustee. The trustee does what he or she does, gets it all sorted out, does what he or she does. All they do is receive the money and pay the premium. So I make the transfer to the trustee pays the premium, nothing happens. Year goes by again, I send the premium to the trustee sends it to the insurance company, nothing happens. Very simple. There are no tax attributes or anything that flow off the life insurance because it's life insurance. It's all contained in the policy. And we just do this on and on and on. And this is a great technique to move assets out of the main estate and have the life insurance the old English idiom, have your cake and eat it too. You can have the insurance and have the policy, but not have the burden of the estate tax on it. The other thing, which is also very, very valuable for this, and this is where a lot of clients are going to say, well, Mike, we're not that wealthy of a family and we wouldn't have, such a large insurance policy, but, we do think we need the insurance. Particularly this example, say, I've had some clients like this say, we're the family of the example, we work, my husband, he works in construction, he's a contractor, he's a general contractor. In fact, I work with him in the business. We kind of do the construction business together. Anyone who knows anything about construction, it's a little high risk. People sometimes get upset, there can be problems, and we might get sued. And we might be liable for this lawsuit. And this is not the kind of lawsuit that we can have umbrella insurance or things like that, because this is a professional negligence thing. We could have a problem. And because we work and we support our family with our labor, it's really important that husband and wife, we're living and available for our kids and working. And so, Mike, actually, we're not that wealthy. We don't have this estate tax problem. That's not the problem that we have. We need the insurance because if my husband, something bad happens on the job, we will never have any more money. It will be very, very hard for us to have more money. So that insurance is really what we need to accumulate and protect the kids in case something happens. It's a dangerous job and it's a risky job. And so we're more afraid that what if somebody sues us? If we have life insurance, can they take the life insurance away from us, our permanent life insurance policy? Scary thing. I say, well, if you just buy the life insurance yourself, you just buy the $1 million policy yourself and you just own it, husband and wife, yes, creditors could take the life insurance policy away from you. They could take the residual value. Your exemption, your state law exemption on this is only about $14,000. So if you're using this life insurance policy, really for safety, if you just buy it directly, it is at risk. And I say, well, but we really need this policy. It's for safety. I say, well, that's fine, because there's a solution. Use the irrevocable life insurance trust. Because just like we have with the estate tax design, the irrevocable life insurance trust, you do not own. Husband and wife, you do not own that policy. You're the insured life. So you are the insured life for measuring when the policy is triggered, but the beneficiaries of the policy are your children, or sometimes it can be your spouse, can also be available as well. But it is held by a third-party neutral trustee. You just contribute the funds year over year over year. If, let's say, this happens, the person is contributing, the insurance has fair value. The person gets sued, and they say, and let's say they lose the lawsuit. They say, you've lost the lawsuit. You're going to have to essentially file bankruptcy. You have to turn over all of your assets. You're still going to have the irrevocable life insurance trust, because you don't own it. It's something else. It sits to the side. Everything that was paid in up at that time stays there. The policy stays in place. If unfortunately then the person passes away, the $1 million is triggered. It's in the irrevocable life insurance trust. It's locked up. It's protected. That creditor problem that the dad had is not going to get at that trust. That $1 million will be available for kids and will be used to take care of them. The issue for the father would never come around. The irrevocable life insurance trust works very, very well for asset protection planning as well as estate tax planning. So you can think of it, okay, we're taking that position for the IRS because we need to solve an estate tax problem, but you can use the exact same reasoning and the exact same concept to solve for debtor-creditor problems. It's a great way with the irrevocable life insurance trust to basically create a fairly stable long-term family bank. Because with the irrevocable life insurance set up correctly, you still have the ability as the principal, husband and wife, to borrow against the policy. So if I'm the contractor and business is good, I'm funding the policy, funding the policy, funding the policy. If kids grow up, they need to go off to college, I need to settle things down, I need a little bit of extra cash flow. There is cash value in the policy. I ask the trust protector asks the trustee, we draw that out, I borrow against the policy. I then begin paying it back in. I get sued, I can keep paying back into trust potentially. Why can I keep paying back into the trust? It's a debt. And you say, well, wait, isn't it your money? Legally, it's not. It is not legally my money. I can't terminate the trust. I can't say, I just want the cash now with no obligation to pay it back. I can't say that. I can borrow, but I have to pay it back and I owe it back. It's segregated. So the irrevocable life insurance trust has great asset protection uses, and I often recommend it to persons who are in areas that are risky. So my contractor example, I have a lot of clients who are in contracting. I say, this is a great thing for you. You are in a risky profession for two things. Risky as in you may get sued, and risky is, my family was in trucking for many years. It's also a risky profession. There can be accidents. So what do we do when there can be accidents? We insure. And when you insure against it with the life insurance, not only can we insure against it, we can put it in an appropriate container that then ensures that if you save all of this money and you say, I want to fund this policy, it's going to be $1 million, or so, and it's somewhat expensive, but I need it for protection. It can't be just suddenly snatched away from you. If it's in an ordinary bank account, savings account, brokerage account, it could just be snatched away from you. The irrevocable life insurance trust, that with a permanent policy and the well-established life insurance trust, that can really be the enduring bank that even if I personally go through significant problems, I'm injured and I incur significant medical bills, I'm sued, all of these things, that's not going to get into the irrevocable life insurance trust. So a very, very durable structure for the irrevocable life insurance trust. So let me pivot over to just one other thing, just make sure we're going well. Actually, I use a little bit too much time there. I'll just go into estate or the asset protection ideas here, which pivot off of the ILIT, the irrevocable trust. So let's think about this a little bit. Asset protection planning in steps. Asset protection planning is complicated. So first, it's generally important to consult with a professional. But let me tell you what my analysis actually is before. So I could just jump in with what I'm actually going to be talking to you about if you consulted me, which will give you a good window into what we're thinking. There is whenever you have asset protection thinking, you have to do your activity, your movement, your action, you're creating the structure before the problem. You have to start thinking asset protection and thinking up the design and how are we going to be careful before the problem happens. And this is a central feature in the common law, which is called fraudulent transfer. California, we call it voidable transfer, but this has been in the law since the 1500s. It's called the Statute of Elizabeth, that it basically says actions that are to delay, hinder, or defraud creditors can be avoided. It can be reversed. So if I'm sued and I transfer my house to my brother, I think, I got sued and I transfer my house to my brother. They're not going to get the house. They're just going to sue my brother and take the house back. It's automatic. The fraudulent transfer law will undo transfers that are to delay, hinder, or defraud creditors and that render me essentially insolvent. So asset protection planning does not work well when we say, oh, I'm going to do nothing. And then if somebody sues, then I'll pay a little bit of money to get some advice. By that time, you'll pay a little bit of money to get the advice, and everybody will say there's nothing you can do, because anything you do that depletes your pool is a fraudulent transfer, because you are lowering the amount that could be available for creditors. So what should you do for asset protection planning? Just like my ILIT example of creating your permanent bank with the ILIT, my contractor example, he did that before there was a problem. He did that because he said, there may be a problem. I know I work in a risky industry. I know there's lawsuits. I know there's accidents. I'm going to ensure I'm going to set it up now. So if he funds this 3, 4, 5, 10 years and then gets sued, you can't claim that that was a fraudulent transfer. Why not? Because how could I commit fraud if I didn't know I was sued? I never met you for the past 7 years. There's no way I could defraud you. I didn't know who you were. Perfect. Because you can't defraud somebody who you don't know who they are because they didn't exist. So that ILIT design works very well. So ILITs are not the only thing. You also can think of a few other trust designs. There are gifting trusts to kids, to grandkids, to other persons. You create the trust and then you fund the trust. Another thing, though, that we should be thinking about, and I think this is just good practice in general for most families, is to consider a recorded homestead exemption. California, this changed again in about the year 2021, that we got an expanded and actually somewhat useful homestead. We're not as good as Texas or Florida, that are really, really valuable homesteads, but ours got better than it was. Our homestead prior to 2021 was $100,000 for a married couple, $75,000 for an individual. I don't know about you, and I've lived all over in California. I don't know of any place in California where you could get a home for $75,000. It was just paltry. So what has changed in 2021? We now have the expanded homestead number, and it is now the base number for most counties is $600,000 adjusted for inflation. For Santa Clara County, now we're about $688,000. We're almost $700,000. This homestead exemption, this says if somebody sues me, I could even lose the lawsuit, but that equity in my home they could never take, and they couldn't force sale of my home. And in fact, I could even file bankruptcy and I could keep all that equity, no problem. You get this automatically in the law, but what can be very helpful in case one sells your home and transfers the home is to do a recorded homestead declaration. So you, and if a single person or you want a person and a spouse, can file a joint homestead declaration, and you record this with the county recorder. So you have, of course, your grant deed, maybe you have your first mortgage, maybe you have a HELOC, and then you have your homeowner's declaration, your homestead exclusion recorded. It's helpful to have a recorded homestead exclusion because if I sell that property and then I want to take that $700,000 cash and then put it into a new property, as long as I sell this one and then put it into the new one within 6 months, that gap period where I have the cash, also safe. So when I transfer, where even if I'm sued, I say, well, I want to sell house A, and then I'm going to have cash, and I'm going to buy house B, the recorded homestead exemption will exclude the whole thing and protect the whole thing during that period of time. So that's something to think about. The other thing that one can think about, again, with asset protection is you really have to go through the analysis of where is the problem going to come from. So everything that we do and everything that we encounter in life, and this is from a famous torts professor, the law of accidents, is whatever I do or don't do, I'm sort of sending out risk rays. So these risk rays are coming out of me, and I need to know where they're going, because I need to determine, or at least try to estimate, what is the profile of the problem. So our contractor example, his risk rates were job work. He was going to get sued for construction defect, construction deficiency, and he was going to have a problem there. That's one thing. He could have been sued for an accident on the job that he was responsible. He could have been sued for employment. He could have been sued for that. Could have been sued for environmental. Somebody dumped a bunch of paint in the creek. He could have been sued for that. Pretty significant stuff. Those are the risk regs. So he's a high risk person. Doing that ILIT with the asset protection, doing the homestead declaration, he should probably start doing all of it. Thinking through more sophisticated asset protection, rental real estate, having it be in a, perhaps a California LLC with maybe a Wyoming LLC on the top, with maybe an irrevocable trust above that, and the beneficiaries are multiple people. That may be appropriate if he, which is not uncommon for people in contractors, start accumulating properties, own the real estate with not just the California LLC, likely a holding LLC above that or above the LLCs, and then have an irrevocable trust over there. That can be very valuable. There could be a number of permutations for this. But thinking through the other side, let's say for me, I think about, well, I don't have like environmental liability, and I don't really have employment liability. I only have really a couple of employees, and they're paid salary, so they're way above the wage hour issue. So there's not a problem there. What's the problem? Professional negligence. Well, I can insure against that, so I can get a really hefty insurance policy to take care of that. Well, I'm not as risky of a client. Maybe I don't go all the way for my asset protection planning because the risk is lower. So that would be essentially the way that we think through the problems with consulting the professional. Is one is we make sure there's no fraudulent transfer problems, because very little one can do when that happens. The next thing we take a look at is where is the risk coming from? What is the risk profile? Is there any way we can insure against it? Is there any way we can ameliorate it in other ways? And then if not, then we start thinking through, usually involving some design of a trust, and they can be, again, a number of varieties. They can be a simple form as a California irrevocable life insurance trust, to something very complicated, such as like a Wyoming asset protection trust, that is a Wyoming self-settled asset protection trust, where the assets, one puts $1 million into it, goes into a Wyoming state bank with a Wyoming trustee, and then it periodically pays me certain amounts. It pays me essentially almost like a salary during my lifetime, something very extreme like that. So there are a number of variations. So how about that's just a little bit about us, join, we're a little past 45 minutes here, to join in and see about any questions that anyone may have.
Yes, thank you, Michael. There's a lot of information for us to digest and very insightful. Thank you. Now we open to the floor, and if you have a question, you can type in the chat box. And personally, I do have some questions.
Yes.
With the way that the stock market is this year and as well as last year, so if some of my clients, they have, say, big capital gains on stock, how do we plan, especially sometimes, I would have like clients also give some stocks to the kids. So how would, a lawyer address this angle?
Well, this is, fortunately, this is now the situation that we're having. This, as it goes up and down, I had a state tax case a few years ago, the market were very, very low now. Now we're starting to see a reversal, we're starting to see gains. So this is the key thing when we ever look at a potential transaction, such as first as a sale or as a gift. Before you do either of those things, consult with a professional and do a little research before you click the button on Schwab and say sell. Because once you sell and it converts from the asset to cash, that is the tax lawyers call it a realization event. The income has gone from capital asset to cash in your hand. And once that happens, there is so the number of options you can do diminishes. So one of the things, if the client says, my main concern is that this stock, a certain AI tech company that will remain nameless, I'm going to have a lot of capital gains on this. And I've had a lot of clients say, but I really want to sell this because I am so concentrated in this particular stock, I am really at risk. Because if this goes the other way, if I become, like other tech companies, and this reverses on me at the end of the year, I'll have been a fool to not diversify this. But I need to do it in a smart way. Then we start to think about, well, okay, there are trusts, like the charitable remainder trust. I say, well, client, do you need all of that money right now? Client says, no. In fact, I don't know what I'd do with it. I'd probably just put it into ETFs or try to diversify it. That's what I'm trying to do. I'm trying to get out of that position and get into another position, and then just be more diversified and safer. Say, maybe what you want is the charitable remainder trust. Before you sell it, when it actually is still a stock, we create the trust. You grant over $1 million or $2 million of the stock into the charitable remainder trust. You could be the trustee, by the way. We don't even need a third-party trustee. And you sell it. And you sell it, and now you went from 2 million in stock, now it's 2 million cash. That sale does not trigger the capital gains to you. There's no capital gains tax for you. Instead, you now have the $2 million cash. And the way the charitable remainder trust works is that it will then pay you an annuity. And this annuity is it's not like an annuity off the market. What it's designed is it's a self-designed annuity. It will essentially pay you a fraction of that 2 million over 10 years, 20 years, or your lifetime. And you'll get this stream of income. And so the 2 million that you would have paid tax on, which would be 23.8 plus California, that's about 10, that you would have paid about 33.8% tax on, you're not paying in year one. In fact, what you're doing is you're spreading this $2 million, this gain, over 10, 20, maybe longer years. And you only pay the tax when the trust disperses the fraction to you. You get a K1 and you'll pay the tax at that time. You spread it out. In the meantime, the trust can diversify the assets into, let's say, I'll just do ETFs. And S&P 500 ETFs, I'll be broad market. I'm not going to be all concentrated in this particular stock. During the pandemic, I had a number of clients that had this problem that are having, and particularly last year had this problem of that during the pandemic, their stock was really hot. And then the pandemic was over, that particular service that they did kind of declined, and the stock went right down. And a lot of people say, man, I should have sold that at that time. This charitable remainder trust works well is you spread the capital gains tax over a very, very long time. And because you don't pay the capital gains tax in year one, that 33% of the 2 million that I would have sent to the IRS, I keep that and I use that to make money. So that amount stays in the trust that I would have just paid and would have been gone. That actually can be invested and used to make money. And I just, what I pay tax on is the disbursements year over year, year over year. There is a little bit of a caveat. It is a remainder trust. If I pass away, the remainder drops down to a charity that I chose. How do we solve this? We use my favorite tool, the life insurance trust. And if I'm an appropriate client that can be assured, I have life insurance to protect against my passing. Charitable remainder trust prevents recognition of the capital gains tax urgently, and which is fantastic, the vast greater statistical likelihood I will outlive the charitable remainder trust. I'll live past 20 years. So I'll essentially take most of the money out of the charitable remainder trust. I'll use up the term in the trust, and the family will also live past the life insurance trust. So I will have enjoyed all the CRT benefit, and my family will enjoy the life insurance trust. I'll have benefited from both. There's one other caveat, or I shouldn't say caveat, one other technique to this that can also be used with the charitable remainder trust. I'm assuming a private charity like the Red Cross or something like that. If I'm of substantial wealth, I may wish to consider using a private family foundation as the charity. And with the private family foundation, essentially, what would happen here is life insurance, that goes to my family, charitable remainder trust, I use that, and then ultimately, when it is time for me to pass, that remainder in the charitable remainder trust doesn't escape my family. It goes into the Lee Family Foundation, which then they will use for charitable purposes in the future. So in this situation, all of the funds essentially stayed with the family, and I reduced the capital gains tax as much as possible. But in order to do all of these things, I had to have thought this through before I clicked the button. Because I have a lot of clients. Now we're in early tax year. I don't have as many have this, but I have a lot of people usually around Thanksgiving that say, "Oh, I talked to the accountant, and they said my estimated taxes are like huge. What do I do?" And I say, "You already sold it. You have 2 million in cash now. I can't undo this transaction. You have to talk to me before." And this CRT, this works well for stock. Same for rental real estate. If you have the same problem with rental real estate, if you have a 5-unit building and you say, I'd like to, I'd like to sell this 5-unit building, but I've depreciated all of the basis. I talked to the accountant. He says the depreciation recapture will be enormous. Say, what if we do CRT? And then we'll do that, and perhaps maybe we'll even buy another building. We'll just change the asset, or we'll buy some other thing. We can do that as long as we can meet the CRT requirements. So that would be the thing, is before doing the transaction, think about, before you click the sale button. Just to pivot on the gift side, if you are gifting stock and you are gifting the stock to other persons, do remember that you will generally need to file a gift tax return, and those are due in the year after the gift is made, at the same time your 1040 is due. So the April 15th date is the same date. And the reason you have to do this when you gift stock or you gift other assets is because of the valuation. On the Form 709, which is the gift tax form, you have to tell the IRS how much the thing was valued. It's readily apparent, it's readily determinable for stock, but you need to tell them. The one that's really tricky, I shouldn't say really tricky, but where you really need to file this form is if you gift real estate. If you gift real estate, or you gift, which is also very common, I gift real estate via an LLC. And so, like, here's how this transaction would work. And it's actually a good tip for everybody. Ideally, when I'm buying rental real estate for flexibility, it's advantageous that I create an LLC and I buy it with the LLC. And then when I buy it with the LLC, I'm not subject to the change of ownership rules in the same way as individuals. So if I want to give 49%, basically less than 51% to my son, as long as I don't give him a controlling interest, as long as I don't give him 51%, I could give him 49% of the LLC, and that would not be a change of ownership. So he could get 49% of the rents, I could get 51% of the rents, and it will not change ownership for property tax purposes until I pass away and give him the other 51%. And that would be very good in that we could do this with maybe even multiple properties and things, and we can have a good division.
That's very helpful. Yeah. So we definitely will encourage everybody who is thinking about selling, try to plan ahead, and also consult Michael on whether any of the solution will fit the scenario. Definitely, yeah, it's very, very helpful.
Oh.
Yeah, so we got a question from one of the attendees.
Yes.
And she indicated that the mother has put 60% partnership interest in a revocable living trust and would stay in the trust when inherited by the son. But when the son inherits the mother's 60%, when the mom passed away, even though the 60% partnership is not outright distributed to the son, do you think there would still be a step-up basis for this partnership?
Yes. So essentially, it would be like this. The key things of why this would work and why this is okay is that the key thing is the mother has the partnership interest in a revocable living trust. So everything, all capital assets in a revocable living trust, real estate, stock, partnership interests, LLC interests, those will all get a step up in basis because they're in the revocable living trust and they are subject to the gross estate. So that 60% interest in the partnership, that will get a step up in basis at the death of the mother, even though the trust says it is not distributed to the son until he reaches a certain age, or maybe is never distributed. It's just held in trust for him. It will have a step up in basis at the date of the death of the mother. The other interesting thing, though, is on the partnership, and this is actually complicated partnership taxing and accounting. You could, let's say that 60% is not distributed to the son, and there's 40% of somebody else. For partnerships, you can transfer outside basis to inside basis. So what can happen is if that partnership has two pieces of real estate in it, it can take the son's outside basis that got stepped up, pass it to inside basis, and essentially 60% of each of those real property parcels got stepped up for real property, got stepped up for capital gains taxes. If one sold and then the income's distributed, you could treat that 60% as stepped up inside the partnership and reinvest it, and you don't have to distribute it out. So outside basis can be passed to inside basis. So the long story short is that one that works. That's effective.
Sounds good. Sounds real good. So I have another question. Asks about like if rental properties still have mortgage. So basically the trust can still be done, right?
It is complicated on this one. Revocable trust, of course, the estate planning trust, of course, you can always do that. The Garn-Saint-Germain Act says you can always do a revocable estate planning trust. The question is that is trickier with things like rental real estate with loans, and you're doing either an LLC or an irrevocable trust. And this is one of the things that is challenging for the lawyer, is that generally most deeds of trust, which is the mortgage, says transfer to an LLC is a non-permitted transfer that causes the loan. It could be cause the loan to be called due. It also usually says some kinds of trusts that are irrevocable violates the due on sale clause. This is something that really has to be analyzed on a case-by-case basis, depending on the kind of lender. Some lenders, you can simply ask for the lender's consent. You turn over the mortgage statement, there's numbers to call, and you call one of the numbers and say, I'd like to transfer it to a husband and wife LLC or the owner LLC. It varies by banks. I've had the spectrum of some people where they say, I want to transfer it to a single, the mortgage owner and the original borrower and everything. It's all the same. We're just gonna put it in an LLC in between. I've had some banks say, oh, sure, we'll do that. It's like $500 just for us to do up the paperwork. No problem. I've had some of them say it's extremely expensive. I have some of them say it's like $7,000. I've been quoted on this. I've had some that say there's no way we'll allow it. So I've had all the way to the spectrum of they say, oh, it's just a little administrative fee for us to update the records, no problem, to some that are very against it. I would say in this situation, the pattern that I've seen, more commercial style banks, if you're dealing with when you got the loan for the property, it was more like a Bank of San Francisco, Bank of California, back when First Republic was around, they were very easy to deal with. Other banks where I basically bought it like, well, this is the one that's hard. I had my family house. I got just a regular old conforming home loan, just as the homeowner, because I was the homeowner. And then I bought another home and I became the homeowner, and that still has my original first-time home buyer mortgage. Approaching that bank and trying to have that be converted into an LLC is sometimes very hard to impossible, because they say this was a like, you know, Fannie Mae, Freddie Mac conforming loan. I can't make this like, it's better we just all say that this is the same thing it was, because I don't want to, nobody really wants to change this loan. It was a good loan. So that would, I'd say, in my experience, one has to be careful, and it really depends on the bank and the kind of loan and the property that it was.
Yeah, thanks for explanation. Follow-up question. Regarding the LLC, say the owner's LLC, so say the parents may own 51% and the kids say own 49%. So by forming an LLC, that if the parents pass, they transfer their ownership over, it would not trigger a property tax change. Is that correct? And that's why that we need to form an LLC?
Exactly. And basically what we're trying to do, so here's a good example. Here's a technique that actually everybody can, is the first thing that we have to know is that we say the original owner of the property, when we approach the property, has to be the LLC. So before I close, before title happens, I need the LLC to be the owner. So that whoever was the original owner, Bill Smith, it goes Bill Smith to LLC, not me. I can't do it as Bill Smith, Michael Lee, and then I put it in the LLC. This won't work. So first things first is we have the LLC. The next thing we can do, interesting technique, is this. So let's say I'm buying an apartment building. It's going to be a pretty hefty asset that I want. And I say, okay, and I'm married. I say, here's what we're going to do. We're going to create the LLC. It has to be husband LLC and husband half, wife half. And we're going to write in the documents that we say, husband half is my separate property. Wife's half is her separate property. And the reason we do this is because we have 2 kids. And in my trust, I'm going to say, my half, dad's separate property half, goes to my son only. And mom will say, and my half, mom's share, goes to my daughter only. And in this situation, we took title as the LLC, half. The estate plan shows that half goes to son and half goes to daughter. And it's not community property. It's not mixed between husband and wife. And it goes son. So like if I pass away, my daughter doesn't get this half. And if my wife passes, my son doesn't get her half. It goes, boy to boy, girl to girl. If we keep that property will not have a change of ownership. And if my kids perpetually keep it split between the 2 families, it will never have a change of ownership, because it never changed control between side A and side B. It was always split. And this follows a case called the Ocean Avenue case, which is Michael Dell from Dell Computers. And he bought the Santa Monica Fairmont for some, not for tax purposes. He bought the Santa Monica Fairmont with him, his wife, and his wife's brother. And then him and his wife had the marital agreement that said, that's your part, that's brother's part, and this is my part. And they bought in these shares because they bought the Santa Monica Fairmont, the LLC that owned the Santa Monica Fairmont Hotel. And they didn't change any of the fractions of the original LLC. They bought it exactly in the proportions that it came from. And so that case, which it was fought a lot by Los Angeles, and Los Angeles has the ignoble sort of history of that they lost at every single court. So they lost at the the Superior Court, they lost at the Court of Appeals, and they lost at the California Supreme Court. The law is crystal clear. As long as you don't change the fractions, it stays separate. But you have to do that. You have to prevent the community property thing. So like average, like husband and wife to say, oh, we'll just buy husband and wife LLC. We'll just kind of throw it together, and then we'll do this like half and half split in the trust. That won't work. You have to make it very clear that the LLC is not, each interest is not community property, because community property means we own the whole. Then we had it together, and we did split. We have to start that it was separate, and we have to keep this separate throughout. If we do that, it will work great.
Very good suggestion. So I have two more questions. It's a follow-up question. What type of trust you would have set up, say, if the asset lasts for multiple generations rather than just one generation? How would approach you?
This approach has two ways to approach it: a simple way and a complicated way. Simple way first. Simple way is that I want a multi-generational amount, is that I could have just in my revocable living trust, is that I'd say 40% will go to my son, 40% to my daughter, and then the remaining 20% will be the perpetual family share. And that will be that 20% we're going to have allocated, and that will be built up. And we may even have the stricture that we say, and that perpetual family share, family members can borrow from it, but principal should generally stay held in the family share. So it will give you a preferred loan. It will give you a 3% loan, so you could do things that you want, but we always keep it replenished. That would be a very simple way to do it. I don't have to do any tax planning in my life. I don't have to deal with this as an irrevocable trust. When something happens to me and they do the estate administration, they'll create this 20% share. And they're already doing this. They're already creating the estate bank account. They'll do it there. That's very common. People will do that. The other way to do it for a multi-generational trust is I create the multi-generational trust now. And I create the irrevocable trust now, and I start funding it now. That's more complicated because I have to live with it now. I have to create it now. I have the expenses now, but it is sometimes necessary if I am a high net worth family, because I say, Mike, I heard the first part of your lecture. You're going to get taxed. I got to get this out of the box. I can't wait until I pass away because my box, the revocable living trust box, is too small. I have to every year use that annual exclusion and get some out, get some out, get some out. Then you'd go the other way. So that's there are two ways to do it: simple and easy. Both work.
Got it. So I have another question that asks about the LLC, different type of asset protection. So they said, if you already own rental property and plan to put it into an LLC or Wyoming Statutory Trust, or held by Wyoming Holding LLC, is it protected? So how do you actually see the difference in putting a property in California LLC versus maybe out of state, like in Nevada Trust or Nevada LLC or even North Carolina LLC?
Exactly. So with this, I would answer this way. First, we're not talking about the California property taxing system. That's a totally different thing. That's the splitting it up. We're talking about here asset protection here. So the first thing that I think about first with the asset protection is there any fraudulent transfer risk? Have I been sued by anybody? Is there any risk there? Because if there is, whatever I put it into, there's some risk it's undone for a fraudulent transfer. Okay, there's no problem. I don't have any lawsuits. Okay, so no fraudulent transfer problem. Then the question is, can I put it into the Wyoming LLC or the various LLC or the statutory trust? The answer to that is yes. I can make that transfer into the asset protection vehicle, but before I do that, I have to run through my checklist. Mortgage company, is it okay with my mortgage company? HOA, is there some weird thing with the HOA? It's going to cause some problem. Homeowners insurance. This one I've encountered a number of times some problem, that the particularly when you may have had a property that's a second property, and it's under your umbrella, be careful. Oftentimes when you look at the umbrella policy and talk to the umbrella insurance people, they say, oh, no, no, no. If you put that in an LLC, it is not under the umbrella. You need a commercial policy for that, and the LLC has to be the buyer. We cover Mike Lee and Mike Lee's stuff. Once you say that's, Wyoming Ventures 8647 LLC, we don't cover anything for Wyoming Ventures 8647. We cover Mike. And that can be something where one can sometimes when you're trying to do the LLC, you created more risk. You had a couple $1 million umbrella protecting this thing. But then when you moved it out, you lost the umbrella, and you now are maybe under only ordinary insurance, and maybe that ordinary insurance is more expensive for less coverage. So that would be the thing that I would say is you, before you again do the transfer, do that checklist of everything connected to the property and make sure, okay, is all of that not going to get affected by doing the transfer. The other thing that will be important is if you do the transfer from one's own name to the structure, the LLC, is when you do the lease, if you already have a lease, you have to update the lease with the tenant. And then when you do the new leases, make sure that the lease is with the LLC, because you could have an ugly lawsuit that if I have the lease with me, Mike Lee, and then I transfer the title, and I have some big problem with the tenant, they'll of course have all the landlord-tenant laws, but then they'll rope me back into the lawsuit to say breach of contract, because I had an agreement with Mike, so he signed it. That's his name. Just because he changed the title, doesn't separate him because he signed it. And I say, oh, nuts. I needed to let that lease expire, then have a new lease that's Wyoming Ventures and tenant, and I'm not signing as me anymore. The other thing, we mentioned already is about mortgages. Make sure mortgages. The other thing to remember with less of a problem with the Wyoming statutory trust, but an issue with the Wyoming LLC is if you have a foreign LLC, the foreign LLC holding the California property is not necessarily optimal. Why is this not optimal? If I have the Wyoming LLC hold the property in California, that's considered the Wyoming LLC doing business in California. Then the Wyoming LLC has to register with the California Secretary of State as a foreign LLC doing business in California. So I have to pay the $800 anyway.
Mm-hmm.
And then the other key problem is my anonymity gets blown, because when the Wyoming LLC has to register as a foreign LLC in California, it has to name the members and name the managers. So that kind of the protection under Wyoming law is helpful, but it's a little bit weakened in that the anonymity is not there. Oftentimes, because of this, because you have to pay the $800 anyway, we will actually do the California LLC touching the property, and the California LLC is owned by the Wyoming. So that when the California LLC says who owns it, who owns 742 Evergreen Terrace LLC, you look at Secretary of State and says, oh, Wyoming Ventures 375. And then you look at Wyoming Ventures in Wyoming and says, oh, we don't disclose who the owners are. And that way you maintain the anonymity, the ultimate value, because this LLC is owned by the Wyoming LLC, the ultimate owner between you and the LLC is Wyoming, so you have the Wyoming intermediary, but you don't have to register the Wyoming LLC as a California entity, and you don't have to disclose all that information. And since you're paying the $800 anyway, either way, you might as well have some separation. The annual cost for a Wyoming LLC is generally between $100 and $150 a year. It's quite inexpensive. And a number of people often will do it where you have just one Wyoming LLC as the holding company, and you have California, and then my Texas properties are in Texas and they're in LLCs, but Wyoming is the hub and has all of them. So whenever anybody looks up, Texas, Houston 55, they say, oh, wait, it's Wyoming, and then, South Carolina, it's Wyoming again. And it just keeps some separation from who I am to the tenants. And also to the tenants also looks more professional. It looks like you're renting from like, the oak, you're from a organized system, which is good. You want to give that impression that, I'm a real estate professional. I do it professionally. I have it all set up, just like professional landlords, which is good. To kind of indicate, the sophistication.
Very good. Yeah, very, very detailed and helpful. So Michael, I do have one last question. So then we'll wrap up today's presentation. I have a number of clients who already moved to other state, especially state income tax-free state like Nevada, such as Las Vegas, like Florida, such as Orlando, or even some of thinking about maybe going to Texas. So can you shed some idea about, like, say, how would be a legal and also tax effective way to approach this retiring in other state from California?
Yes, it is a super common idea and can be really a great fit for a lot of retirees, especially if my parents did the reverse. They lived in a rural part of California, and then I brought them here. If it can improve your life, it can be really important. Like my parents, they do much better. There's a lot more amenities here. So moving to the appropriate state, good idea. The key thing to think about is if one of the things that moving to the state, like we've listed Florida, Texas, Nevada, these states, is the tax benefits are important. We need to think about how you get the right to claim the tax benefits. So how do you get the right to claim the tax benefits? It's by actually moving and changing your state citizenship to Nevada. So most people know the superficial part. They say, okay, I'll move there, I'll rent or I'll buy a house there. Okay. Next thing, I have my mail sent there. I file my tax return and I show that's the address. I change my driver's license. But then we start to get more troublesome things. Now are we going to re-register my cars? Okay, I got to re-register. I got to give up my California plates, get Nevada plates. Okay, now I need to insure them under a Nevada resident, Nevada registered car, Nevada insurance policy. And I was talking with Monica when we started. You would be surprised how expensive that is. I was surprised. I encountered it very recently. Some of these Nevada insurance policies for the same car are like double the price of California. I think, we're always shocked as Californians when something's more expensive than what we have. And that was something that was very surprising because of the limited market for used vehicles in Nevada and the limited number of repair places and access to parts. Insurers find replacing a vehicle in Nevada with the identical thing more expensive than like LA. If you want a 3-year-old vehicle replaced, they say, give me an hour, I can get you the exact same thing. In Nevada, it's really hard, and so it's expensive when the insured person says, I want you to give me either the money for the exact same car. That exact same car is more expensive there. So insurance is expensive. The other thing, speaking of insurance, which is a problem, is changing your health insurance. Because again, if I'm a Nevada person and I'm in Reno and that's home, my doctor should be in Washoe County. He or she should be near me. If I say, Mike, I kind of like Stanford, I like USF doctors, I don't really like this Washoe County thing, that's going to be a little bit of a question mark, because if you generally live when there's a problem, you live near your doctor, you live near your dentist, you live near your optometrist, you live near your accountant, your lawyer. When one moves, you need to create your professional network. So that can be something to think about, that if one says, well, I was going to kind of do it on paper, I was kind of going to do a paper move, you will quickly find that it's not going to work. And I was telling Monica also about one of my favorite cases, but it's a case that's known amongst practitioners in this area, and it comes about from this problem: is that if I still have California source income, I still have a rental property here, I still have something here. When I have to file a California income tax return for my California source income, I have to attach the federal. And if there's a big difference, California's going to ask me why. And so like if I moved and I sold a bunch of stock, they're going to say, I really want you to prove that you were not a California person when you sold that, because that looks like that should be on our return and we should tax it. A lot of tech people get in trouble with this. And of course, one person did, and all tax professionals kind of they call the case the Starbucks case. The person was a tech person, but from Southern California, moved to Las Vegas, claimed he lived from Las Vegas, and then exercised all the stock options, and basically liquidated all these things and said, no California tax. I don't have to pay the up to 13% tax on that. I'm home free. But they still had a rental in California, so they attached the return. And California, their franchise tax board examiners, the auditors were very clever, and they said, first thing that we want to see to prove residency, we would like to see your wife's Starbucks, or maybe your wife's credit card statements. We want to see the credit card statements. And they got the year of the wife's credit card statements, and they just took a highlighter and they just highlighted the Starbucks coffee. And they said Newport, Corona Del Mar, Newport, Corona Del Mar, Lido Beach, Corona Del Mar, Newport. So every week these Starbucks are at the Newport Beach, Starbucks. Where you live is where you get your morning coffee. It looks like your wife lived in California because every single week she was having coffee on Newport Beach. It looks like the Nevada thing was you just bought a house and changed all of your mail. But where you physically were, according to this, where you were buying coffees, was in our state, in California. And they had, needless to say, they were not deemed a Nevada resident, that they weren't there. So the takeaway from this, the takeaway from the funny story is moving to those places can be great if you say, I actually am intending to move. We have these more borderline issues with a more borderline state, Nevada. In reality, I think if someone was choosing Florida, it is so difficult to, again, it's just a flight. It's just a day flight. But even that, it's going to take half the day for the flight. You will have less crossing over because there's so much physical distance. You will naturally begin to change everything over. But exercise some caution when it is a more borderline issue, because California really takes great umbrage on this. And if you still have California source income, they see the federal return and they will know that there's a difference. And since that's the situation, one would be careful. On the converse, though, to reduce concern, if one is moving to Florida and one is moving to Texas, if you can hold out and not make major transactions, not sell all that stock, in the first year, and you wind down your California holdings, maybe not even sell them, maybe you strategically gift them or you do something like that, and you no longer have an obligation to file a 541. You no longer have to file with the FTB to show them income because you don't have any California source, then do that transaction. And then California you did not have to tell them about that because you said, I had no connection to you anymore. And I didn't even have to report to you. That would probably be safer than doing it in the same year and reporting it all and basically, kind of haunting the franchise tax board. That's probably the riskiest way.
Yes. Yeah. Thank you very much. It's very, very good to know. And so great planning is required. And thanks, Michael, again for the wonderful presentation. Yeah, we all learned a lot. And we do thank you, everybody, for attending today. We're going to share the recording by early next week. And if you have any question, just make sure you contact Michael's office directly. Xiaowei and Michael are a very, very good team that we worked with before. And so, again, thank you. And we look forward to seeing you soon, Michael. Thank you.
Great. Thank you so much, Monica. Take care. And it's nice to see everyone. Be well.
Yeah, excellent. Thanks so much. Bye now.